Good afternoon, everyone. Can anyone hear me? Well, that was a quick response, wasn't it?
I can hear you.
Still sleepy
Hello?
after lunch.
Testing.
Apparently, we've graduated to a bigger room. Did you notice that, gentlemen?
Yes, sir. I noticed.
Yeah, it's great. So thank you all for coming. This is the extended stay, here to stay session. My name is Mark Skinner. I'm with the Highland Group. I will get our panel to introduce themselves shortly, but just want to tell you a little bit about them. We've got a wide representation of extended stay here. We have economy, mid-price, and upscale segments. And we've also got a mix of franchised and corporate-owned and operated hotels. So great diversity in the panel. All right, so let's look at some numbers. Hopefully this works. Okay, extended stay hotel. Hotel with a fully equipped kitchenette in each guest room which accepts reservations and does not require a lease. That is the definition we use in all our reporting. The big differentiator there is the kitchen in every guest room, which most hotels don't have, and it does not require a lease, which differentiates it from corporate or service apartments, which are usually on residentially zoned land, have a minimum stay of 30 nights, and require a lease. So they are not included in any of the numbers that you see. 570,000 extended stay hotel rooms in the US as of January 2023. And just to give you another idea about the panel, 40% approximately of those rooms are represented right here. 10% of all US hotel rooms, 2019, the year that we all look back to as the benchmark, $14.4 billion in room revenue. $4.5 billion was lost, if you like, in 2020 as the result of the pandemic. But look what happened next year. Completely recovered. All the revenues that were the decline in 2020 plus a bit. That took 2 years, just for comparison. The last two downturns, it took about 4 years to do that. And then in 2022, added $3.2 billion in room revenues, which was the second largest increase in absolute terms for 25 years. After 2021, which was the recovery year. Most of that growth was through ADR increases, which increased by 17% in 2022, which was the highest annual increase we have ever reported. And just to look at that, 17.7 billion revenue in 2022, that is 80% more than it was in 2020. So it's been a very, very strong performance. And just a quick word about brands and our segmentation. You see the extended stay brands in that chart there. Upscale, we define as an average brand-wide daily rate of $120. Mid-price, $70 to $120, and economy, $70. And you see all the brands represented. Just to give you an idea of the interest in the segment at the moment, if you come back here in 12 months, and I'm still doing this, and I put that chart up, there will be 4 to 5 new brands in that chart. And I notice from the chart there are 3 beginning with Extended Stay America. Mark, can you explain the difference between the 3? We have Extended Stay Select Suites, Premier Suites, and Extended Stay America.
Yeah, sure. Thanks, Mark. I have not had so many lights on my face since last time I was on Oprah, but that's okay. We'll go from here. Extended Stay America, we've been around 28 years. So as most everybody knows, we're owned and operated majority of the time. And we introduced a prototype a few years ago and threw out and created Extended Stay Premier, which for the most part is new construction. However, we are doing conversion assets. And the difference is we are doing, between the other two, it's a slightly better breakfast, healthy breakfast with protein bars, some fruit, and coffee, so it's limited still. The cleaning cycle, as what we did in COVID, was every 2 weeks, but for Premier, it's weekly. On Premier Suites, or ESA Suites, the cleaning cycle, it's every 2 weeks, but our franchisees can clean every week as necessary, or if at their preference. And the breakfast is pretty much coffee and a limited, purely limited. Our extended stay select suites was created because we purchased a bunch of WoodSpring assets and created a budget.
You're welcome.
Product. Yes, you're welcome.
Thank you.
And these properties, as opposed to the other two, we are 24/7 on both suites and premier suites. However, on the select suites, we give the franchisees the opportunity to have limited operations at the front desk. There is cleaning every 2 weeks, and the breakfast is $0. So it's a budget model, and we're glad to have them. They're doing extremely well, and our whole portfolio is performing extremely well.
Great. Rick, which brands do you represent?
So upscale segment, I represent the Homewood Suites brand. We are 34 years young. We have 535 operating assets. We have another 130 in the pipeline. And of those 535 assets, about 61,000 suites are represented by the brand Homewood Suites.
Ron?
So I guess I'm the only one. I just realized an economy extended stay, which is a very hot segment right now on the panel here, at least. Right?
No, actually, Mark's got one in there
Well,
too.
he's-
Extended stay select suites.
They're catching up.
They used to be yours.
Yeah, we are ours.
That's right. Well, and that was
That's
a
right.
plan, right? We went to
Yeah, we
upgrade our product. So, no, actually, we have WoodSpring Suites, which is our leader in extended stay. I mean, we have across the country, like basically the entire segment. We captured about 94% of all new construction last year for extended stay economy. We're not there quite with mid-scale. We're going to get there. We're moving that direction. We have 14 under construction with Everhome Suites, which is one of the hottest new brands out there right now. We got a lot of interest. We have over 550 hotels in our open and under development pipeline. The under development for Choice is a little different than some what the other competitors are doing right now. There's literally sites and franchise agreements in place for those. So we have a lot of activity. We're seeing some headwinds, of course. I'm sure we'll get into that. But with the pipeline that we have, execution, we should do very well. The other brands we have are Mainstay Suites, which continues to do both new construction and conversion. And one of the strongest growth vehicles we think at Choice is our Suburban Studios brand. We had our best year ever last year. We think in this environment, we positioned ourselves to be right in the middle of every transaction that somebody's looking at to convert.
So you have 4 brands in that chart then?
That's right. Are there 4 there? Yeah. Okay.
So,
Yeah, all of you have got more than one. And Gary?
I've got one.
No, you've got 2, I think.
Oh, 2, you're right. Affordable Suites.
We haven't seen this.
We know our product very well.
That's right. That's right.
So please put forward all your brand questions to these 4 gentlemen. Gary, go ahead. Sorry to
So
interrupt.
first of all, let me just say it's amazing to see the size of the room.
Yeah.
Probably Mark and I have been doing this
Scary.
for 25, 30 years, and we used to get a little corner place to have the panel discussion on extended stay. And so to see this room this big really says a lot about the segment and where it's been going over the last 25, 30 years. And for me, I've been probably the longest tenured of extended stay of anybody in the business today other than Mark. 30 years
younger than Gary.
running most of all these brands that we've talked about and have a lot of good experience, and felt like there was a niche that was missing, and that was an apartment style hotel. And so our brand is Stay APT Suites, very young, launched it in 2020, just right before COVID, and it's taking the best of the hybrid of sort of multifamily and apartment and creating a dynamic that's unique to the industry, in that average size 500 square feet from a mid-price perspective, and targeting really that long-term customer that's sort of both hybrid of an apartment but also an extended stay customer. And in our niche, we have limited hours, so it operates very similar to a multifamily environment, in which the labor model is very small, and we all know this is so challenging today in this environment. All of our managers live in a 2-bedroom, 2-bath apartment on site. Again, taking some of the multifamily tendencies and converting that into the lodging space. And so today we have, by the end of this year, we'll have 30 hotels open. And next year, and that's a combination of franchise and corporate-owned hotels. Next year, we'll have another roughly, call it 15 to 20 corporate locations, another 8 franchise locations. So very excited, should be close to 50 hotels. And having been involved in launching these brands, unlike the big brands, smaller, it's harder to do, we have skin in the game. We own and operate. And so we actually can feel the pain when you're not meeting your EBITDA. And so thinking about how to manage the business and how to build the product and how to refresh the product, you can be certain that having all the experience I've had in this segment, we're not going to do something that looks good unless it's going to help people make money. Because at the end of the day, that's what we're all trying to do this, is to make money. So that's sort of our pitch, and very excited about our niche and the amount of white space available for our product.
Thank you. Thank you, everyone. Any brand questions before we get onto more numbers? No? Okay. Profits. Very important. The next few charts show 2019 and 2021, 2022. As you can see, in 2021, despite the turmoil of 2020, the gross operating margins were almost back to the benchmark year 2019. And this is the economy segment, similar pattern with mid-price, and similar pattern with upscale. But if you look at the similarity between all those charts, despite the big increase in RevPAR in 2021, there was actually a decline in GOPs. Now, firstly, if you were to put these against corresponding limited service and full service hotels of the same class, these are much higher. But they did actually go down. So my question to the panel is, what were the main reasons that average profit margins were down? And what brand initiatives are you undertaking, if any, this year to help your franchisees maintain margins? Who wants that awful question?
I'll take it first. It's a softball for us, right? For Chili's.
Pardon?
We're off the screen here. We're above that 57.4, so I got to at least be able to say that.
You should, yes.
So we're at, we tried to hit 60, couldn't hit it. We were at 59.9% GOP last year, which was our best ever. So we didn't see the erosion with WoodSpring. Our other brands are just kind of getting caught up, to be honest. We need to do a better job at collecting that data, but we also think that they were either flat or slightly up. So we didn't really see the erosion that the industry saw, especially since I don't think any of us really did a whole lot. But I love it, the fact that we're off that chart there. We're at 59, so we can expect that to continue through the next couple of years.
And I love it too, my good friend Ron, because we're at 67% GOP.
There you go.
So I appreciate all the hard work you guys are doing.
It's easier with the
we're
small
partners from way back, but I'm just picking at him. But we're way off. The chart doesn't go that high for us, but that's okay. But anyway, so just talking.
By the way, I learned everything from him. By the way,
just talking about. But no, two things really. I think for us, I think the reason, Mark, last year was wages. I mean, it was crazy. Everybody knows rate. I mean, someone hired today, they leave for 10 cents tomorrow. So that's all. At least started to abate today. It still hasn't gone down back to where it was, but it is sort of stabilized from a standpoint. The other thing is, at least from an extended stay perspective, last year, all of us experienced the demand by the leisure traveler. And there were a lot of leisure travelers that probably didn't know a lot about extended stay, but the markets were so frothy in terms of occupancies were very high, couldn't get into hotels, were trying our products, and so they have a shorter length of stay, so naturally that has an impact on the overall operating business. So I think that's another reason why the margins really were impacted. That I think how it's going to go change is that I think wages are changing and stabilizing, but I think that the leisure traveler is not where it was this year like it was last year, and that's going to help from an extended stay standpoint.
Okay.
Yeah, Mark, from a brand perspective, I mean, what we focused on at Homewood Suites, best way to improve the bottom line is to improve the top line. So our discipline and dedication to the extended stay segment was really what we focused on. So Homewood Suites, for example, has an SPAR of about 43% across the average assets, and that's SPAR. Fairly healthy.
What is SPAR?
SPAR would be extended stay per available room. In some cases, you measure SOC. That's not a true indicator of the health of a brand. SPAR would be a better way to indicate it. So that's how we measure it. What we were delighted about at Homewood Suites is we saw an influx in extended stay during the COVID period. What I'm thrilled about in 2022 is we saw no decline in our dedication to driving extended stay hotels. So the guest, that beautiful base of extended stay business at a rate of $18 over prior year really gave us a substantial foundation to build off. If you think in terms of additional initiatives, we implemented things like 100% pet friendly, not only across Homewood Suites as a brand, but also across Home2 Suites, and then throughout the focus service category within Hilton. Why did we do that? Yes, there were operation expenses attached to that, minimal, but the lion's share of somebody's wallet that you can get with some of these larger housing accounts because you're compliant with pet friendly really drove additional business on the top. So our focus at Homewood Suites, and primarily Home2 Suites too, was really driving the top. It's tough to squeeze a nickel out of the bottom. How about you drive a bunch at the top? So our focus was really on the discipline of extended stay.
You know, Mark, something I failed to mention, but Gary brought it up, is they have skin in the game. At ESA, we have 750 hotels in our system. 550 of those are owned and operated. So this hits home because, and Gary hit it right on the head, it's the labor. Cost of labor has gone up, and everybody's very aware of that. And when you look at states like California and some other states that are just, it's very expensive to do business there anymore. And we've got a large number of assets in a lot of those markets that has hit Extended Stay America, and it's hitting everybody.
Yeah.
It is what it is at this point.
Yeah.
So you mentioned it, Gary. Do you see a leveling off of labor costs this year? Do you see some stabilization?
Yeah. The conversations have got a lot easier, right? Yeah. So I think what makes the extended stay model so attractive is that you're less reliant on the fluctuations of labor, right? So if you think in terms of the foundation of business as it relates to extended stay, and for example, with Homewood Suites, we clean the room extensively every fourth night, fifth day, and then upon request prior to that. But you can really manage the labor costs. If you think in terms of what we've done with breakfast, what we've done with our evening manager's reception on Wednesday night, we've really scaled back the points of engagement for our extended stay guests to zero in on labor savings, but without impacting the guest experience. So we are really manufacturing opportunities for engagement, because the worst thing that we can do in this industry is a guest checks in for 30 days and you don't see them till they check out 30 days later. You have to engage with these guests. So for us, it's been about implementing very positive initiatives that don't necessarily have labor implications, but really drive the guest experience. So we're less reliant on labor because we are extended stay. Transient's tough, mate.
So you mentioned your manager's reception. Now, that used to be 4 nights a week, didn't it? What is it going forward? Because it stopped during COVID.
So it's one night. So we do, yes, it stopped during COVID. And then we have a very, very active owner advisory council within our brand. And what we wanted to create was a point of engagement, right? So less of a transactional experience. Come on down, enjoy an evening social. It's hosted by somebody. You're going to get fairly substantial food, but it's not an engaging experience. So we scaled it back and said, let's own Wednesday nights. Let's literally own Wednesday nights. Let's get all of our extended stay guests down in the lobby and let's have some fun with them. That's the foundation that we've built. Now, where that goes with our journey forward, we're going to have, obviously, our owner advisory council will dictate that journey along with the rest of the owners. But we really think we zeroed in on an opportunity to really engage with these guests at least once a week. You have to, Mark. I mean, you got to look them in the eye.
They're there a long time, yeah.
You got to look them in the eye and shake their hands and talk about their family and how was their day. And that's why they come to stay with us. They're living with us. They're not staying with us. They're living with us. So let's wrap a bit of hospitality around these folks.
I think one thing, Mark, that I just want to add on labor costs, they have slightly gone up percentage-wise. We're at about 15%. I think all of us are probably about the same. I'm almost afraid to say that, Gary. You're maybe a little higher, actually. But we're out of over 200 hotels that we have open with WoodSpring, and then the other 100, we're at about 15%. That was only just 11% last year, but we needed a little bit of a healthy increase because we had a labor shortage issue. So we're seeing a little bit of cost inflation in wages, but at the same time, the rate has outpaced that. So we think at 15%, and those of you in the room that are doing conversion hotels, they're looking at getting out of maybe a transient hotel and can talk about a labor cost of 15%. That's something that we all can say, and it's very. This is one of the reasons why this is so profitable.
Right. Okay. Anyone bold enough to ask a question about costs yet or anything else? No?
Everybody apart from Andy Pettingill who's sitting out there. Andy, no questions, mate.
Okay. You heard me say earlier on, 17% increase in ADR in 2022, the highest one-year increase that we've ever known, which it was. But it wasn't evenly distributed throughout the year. So as you can see from this chart here, well, this is not working, but you can see it. Mid-price and upscale segments actually peaked at about a 30% increase in average daily rate compared to the same period in 2022. But you can see there's a definite trend there that rates were declining in terms of their gains to the prior year as the year went on. And if we put that chart to January 2023, you'd pretty much see the same three lines. But it's important to note when you look at a chart like that, that at the end of the year, the rate increases, although by looking at the beginning of the year, they look comparatively poor, they're actually at about 4 to 5 times the long-run increase in extended stay ADR if you go back 25 years. So rates are still going up at historically a high clip. And the same thing with RevPAR. The trend lines are very similar. Some very, very strong RevPAR growth at the beginning of the year, especially in the higher price segments, which were still recovering, if you like. And then towards the end of the year, particularly at lower price points, it became evident that there was some rate resistance. So just looking at those charts and the descending lines, do you think at any time in 2023 there is going to be a negative change in monthly ADR and or RevPAR? And why or why not?
So what
That's
you're
a
saying
horrible
is
question.
it's going to follow the same trend from last year. Mm-hmm. And,
But does it go below the zero line? Does it this year?
No, it won't go below the zero line.
It won't?
No, it won't. And when we look at our numbers now, and we're in, what are we in, March? Our ADR numbers are across the board within Extended Stay America, at least 5 points above last year.
Yeah, well, if we go back, that's about where
And that's about right. Now, as you look,
holding up.
the line as you go through the year, that may be going down because the length of stay on guests or new contracts coming in is going to be longer. And with length of stay, the rate ADR is going to be down. So I think that will probably continue, but it won't go below. I don't believe it's going to go below the zero line. I mean, we're extremely bullish right now, and we're above the line on everything, ADR, occupancy, RevPAR at this point within our organization. So we're bullish on what's going to happen in 23.
Rick, what do you think?
I am also bullish. And the answer is no, I don't see a decline in rates. I don't see a decline in RevPAR, and there's a reason for that. Again, if you were to take 2021 to 2022 and just take our 5+ rate growth, it was up 18% over prior year. I think that trajectory will continue. So as long as you take care of your extended stay base and the rates that you've got for 50% of your house, it's a great place to build off. What I do get concerned about, Mark, is the rates that we charged our leisure traveler over the course of last year. I think there's a point where is 160 and 170 average rate at a Homewood Suite, is that too high over the course of a weekend? So I worry a little bit about the pressure that leisure rate growth might put on us. But I think BT business is coming back during the week, and I think that's not a bad thing for the asset. So I think the health of the asset, as long as we solidify extended stay rate growth, will be in good shape.
What about you, Gary? You've been in the segment for many cycles.
Yeah, well, I think
What do you
obviously this
think?
cycle, this is like all the 3 or 4 that we've seen that sort of go down and go back up. Extended stay has always been resilient, more so than the transient. I think in 2023, as we look at it, sort of what I said earlier, I just think there's going to be less leisure. I think everybody went out last year and was really traveling, wanted to get out. They couldn't go out anywhere And you recall the first quarter of 2022, there was a big COVID push at that point of the Omicron or whatever it was then. So I think that that's going to have some impact on rate. I do foresee that inflation, and although it's abating, but I think that recession really, that the potential of that in 2023, as things continue to get worse now, the banking, that does cause for pause, and I think it's going to have impact on our rates overall. Now, will it go negative? I don't know the answer to that. I wish I did know, but I think it is going to impact overall the segment and the industry as a whole.
I'm a little color challenged here, so I think the blue is that economy down on the bottom.
Yeah,
No,
blue
no,
is
it's
economy,
the
and we're
top
still
one.
on ADR, and if we fast forward, I mean, the
right.
trend lines are the same.
Yeah,
Blue
it's so
is,
small if you guys
is
saw the
RevPAR.
screen here. But we actually, these don't follow our trend lines at all. And part of it is actually when we did lose the 100 properties, there were our older properties, the ones that were typically 20 to 30 years old. So
Thank you.
I'm not saying, yeah, so it helped our ADR actually has increased. And really the secret to what we can do is add more new construction, because our new construction is outperforming by 30% on rate than what our existing product is. So we're going up, and we've not ever seen a downturn over an annual output. So, and we're not going to see one in 23 from what we see. It could be a little flatter in some areas, but if we can continue to build, and we have 26 WoodSprings going to open this year, new construction, that totally helps the situation, right? Because they're all new products going in and competing in older markets.
Yeah, true. Any questions from anyone there about negative RevPAR, ADR? No? All still digesting that lunch?
Still sleeping.
Yeah, okay. All right. Well, after those two charts, which just on cursory inspection, you might think everything is going south, take a look at these. Economy extended stay against all economy hotels. This is the RevPAR Recovery Index that takes into account all those months in 2022. Against its peer group of, if you like, traditional hotels in the economy segment. 123% of 2019 RevPAR nominal value in 2022. That is the highest of any segment of the hotel industry, as far as I know. Economy hotels in general weathered the pandemic quite well, but economy extended stay even more so. And again, that's a lot of the reason why we're going to have 4 or 5 new brands next year, and we've got a bigger room.
That's right. The demand is 20% higher than supply. So there's some room for some more people to come in.
Mm-hmm. So the same story is the mid-price segment, again, against all mid-price hotels, stronger RevPAR Recovery Index. What is not shown in that slide is that during that period of time, mid-price supply increased by about 9%, where mid-price extended stay supply, increased by about 9%, whereas all mid-price hotels were basically stagnant. So that is an even better performance than just those two bars would indicate. Now, the upscale segment, 99.2% of 2019 RevPAR in 2022. So it's almost there, and it will get there this year, but it lagged the lower price segments a little bit in the recovery, and it also lagged slightly all upscale hotels. So segment representative, Rick, you knew this one was coming. Can you tell us?
I did.
Why?
Mark, I studied this because I didn't believe it, and when I studied it for Hilton, it doesn't follow the same trajectory. So Homewood Suites, for example, was up almost 6%. Hilton's upscale product was flat to 1919 levels, or 2019 levels rather. So I didn't follow the same trajectory of this. So I hate to negate the data on the graph, but I'm glad to negate the data on the graph.
Great. My theory on it, which I hope Rip was going to back up, but he hasn't, is,
Nope.
is its distribution. Upscale extended stay hotels have a much higher, and they're 40% of total extended stay supply, have a much higher concentration of rooms in urban centers. And they were the last to recover. They also tend to be big hotels, and they also tend to have very high rates. I would bet if you were to slice that between suburban located upscale extended stay hotels, you would get a very, very different story. That was my theory, but we'll have to have a pint or two over it and see,
Deal.
Okay,
Mark, what's your theory on rates? I mean, you're an expert in this space too.
I knew that was coming.
Oh, yeah. Interview the interview.
Well, I think what you're going to find at some point this year, lower priced, and I won't say, just economy, just mid-price, because the mid-price segment stops at $120 before it goes upscale. There's a clear difference between 70 and 120. But if you would take those 570,000 rooms and slice them in half by rate, and you look at the lower half, I would not be surprised to see RevPAR post a negative monthly change at some time this year. If it does, and you look back at history, typically what the lower priced extended stay hotels do, now bear in mind, this is on the back of the strongest rate increases that we've ever seen in the most price sensitive market segment of the hotel industry. What typically happens is they start to discount the rate, not increase as quickly, depending on what happens at higher price points. And Rick's just said he's going to keep increasing his rate at very, very high amounts. So that will have an influence. But I do think it will happen, and it will be temporary. I mean, if you look at times in the past, 2 quarters, something like that, before RevPAR starts to return back up. And it's interesting because there was 2 news reports. One I saw this morning and yesterday about shoppers, that they have seen that economy brands, be that apparel, electronics, or groceries, have significantly gained market share on the higher price brands. And they are having, in effect, a trade down effect. If lower price extended stay hotels do suffer negative RevPAR on a monthly basis, ultimately, that will filter out, and I think you will get a trade down effect if the higher priced hotels continue rising. That's my answer.
Yeah. Yeah. I think the other thing too is going to impact is the whole apartment industry. It's been on fire for the last 3 or 4 years. Multifamily's been growing. Rates are off the charts in multifamily, and although maybe it's not directly, it is indirectly, and some are more impacted than others. So I think as those pricing starts to come down, which they've already started,
Yes.
will have an impact overall on the extended stay segment as a whole. And again, some markets more than others, some brands more than others, but I think that's something to keep our eyes on and keep our pulse on what's happening in the multifamily apartment side of the business, because indirectly that is going to have an impact on extended stay.
I would agree, definitely. Recovery, that's what we've been focused on and talking about. So our 100 largest markets report at the end of last year does the 100 largest hotel markets in the country. And all but 12 of those extended stay hotels had recovered or bettered 2019 RevPAR in 2022. So, all right, it stopped working. No, it hasn't. Let's have a look who's fared best. They are the top 5 MSAs in terms of RevPAR index, 2022 versus 2019. And what you notice there is it tends to favor smaller markets. If you were to extend that chart down and start picking up bigger markets, the state with the most of them, with the strongest, would be Florida. At the other end of the spectrum are the markets that have not recovered. They're the bottom 5. There's no real surprise in the first 2. The others, one Californian, Madison, Wisconsin, could be a supply issue there as well, new supply. Minneapolis, St. Paul is a big market. That's a surprise for extended stay hotels. But given that and all the development going on, where are the best places to go now and look for new development? And given that one, where should we avoid, other than 3 places in California?
I like what that graph showed, because it's secondary and tertiary markets that I think there's going to be opportunities. And when we purchased, what's your brand again?
You keep bringing that up.
I know. The WoodSpring, and created our ESA Select portfolio, which is a new brand with critical mass already. We're rolling out our prototype by the end of this month. So we'll have a budget prototype in the next 10 days. These are the markets that I think are going to be very attractive to our investors. Secondary and tertiary markets where the economy product is going to be very successful. If I come in with a, no offense, but a upscale or even a upper mid-scale asset, we're not going to be able to get the rates. These markets, we'll be able to do it on an economy scale, and the construction costs, but the land should be cheaper than what we're looking at in some of these other markets. And I think it's going to be a win-win on the economy side.
Yeah, I mean, I think with Choice, I mean, you look at all these markets, we do well in the smaller secondary markets typically, and some of the larger ones. The next slide, you had Minneapolis on there. That's one we got some diamonds in the rough. You get every market, you can find something. I know you're looking at it, the entire market, but we're looking at Minneapolis in certain areas where we have recently lost some product that left over here. We are finding excitement to look at some of those markets where we can go in and push the rate above our average of 80% occupancy. We're trying to look at occupancy in those markets, and then we're going to play with the ADR a little later. So, but by far, the Southeast, you mentioned Florida is off the charts. We're spending a lot of time in Florida, North Carolina, South Carolina, Colorado, California. Those are the markets that, and the New England area, of course, which you see on the screen. Some of that. Those are the hot markets.
Yeah, for us, very similar. So some of the attractive openings for Homewood, for example, Charlotte Uptown, Estes Park, really great locations, whether it be destination markets or whether it be heavy urban markets. One of the advantages that we had, and timing was perfect, right? During COVID, we worked on a new prototype, which we released in April of 2021. And while that wasn't probably the best time to release a new prototype, in hindsight, it certainly was, because the efficiency behind the build that we created affords us the opportunity to go into these secondary, tertiary markets and flex the size of the asset to generate what we need it to generate from an ADR perspective. So the prototype's done extremely well, very attractive to owners and investors. Pipeline, as I mentioned, was about 130, but we're showing our pipeline is in really nice, very attractive, high barrier markets to entry because you can get both the occupancy and the ADR.
And where should the people stay away from? Which markets? I mean, there's enough coverage here. Which markets are showing stress, other than the ones that...
I don't really necessarily go by city or in terms of location. I think what a couple of people said, the tertiary, secondary, even primary markets, and Ron said this, but at the end of the day, it's really going where the demand generator is. Yeah. It can be in a great market that sucks up here. It could be in a good market that's not so good. But at the end of the day, it goes where the demand generator is, no matter what market it is. And, I heard something on one of the presentations. They said, like, Atlanta had 15 or 18 submarkets, and some of them are doing great and some of them are not doing great. So it's all about going to that right demand generator market within that submarket and make sure you got the right demand generator. Just because you have inbound travel, if it's not extended stay, long-term travel, it's not the right customer. So you got to really segment the details and understand who the demand generators, what's the length of stay, what the inbound traveler wants. If it's 1 or 2 nights, that's not what at least we're in the business for. And if it's more longer-term stay, that's a great market to be in. So no matter what the screen says in terms of the market or the city that's performing or not performing, it's really going to where those demand generators are.
And one of the ways to do that is get Colibri Labs report, and you can see how much extended stay is in a set of hotels.
That's right.
Yeah. Do you use any other things other than STR, Colibri Labs? You look at apartment data or anything like that when you're looking at extended stay markets?
We look at a number of factors. Yeah. And one thing I did want to add, and Rick mentioned bringing out his prototype in 21. We introduced our Premier Suites right in the middle of COVID, and we built on our own dime 13 assets. Wildly successful during COVID, post-COVID, and our franchisees are finding the same results. We hit it at the right time, and which is why you're seeing everybody and their brother now wanting to come in the extended stay market. COVID woke people up, and our Premier prototype has been a huge success, and we thought it was the right time. It just worked.
Okay. Given extended stay by definition has long-term guests in there, staying there a long time. So the question is, how important do you think frequent guest loyalty points are to guests within your particular price segment? Rick?
Sure. So tremendously important to Homewood Suites as a brand and to Home2 Suites as a brand. I think last year, the highest month of contribution by Honors members was October at 80%. So 80% of the revenue coming into that hotel was driven by Honors members. So substantially important for us. What also I think is, and we've spoken to many, many owners about it, if you think in terms of plugging into a system like that when you open a Homewood Suites asset, this thing ramps up just about that, because 60% of the business that you need within your walls, you get plugged into. So for us, tremendously important, no question about it, Mark.
So your guests that are truly long-term guests are accruing an awful lot of frequent guest points, right?
Yeah.
And probably got the...
But for Homewood Suites, we're a feeder to the rest of to the rest of Hilton's portfolio of brands. So you think in terms of those aspirational brands, what we feed is the aspiration of the consumer. So yeah, you've got to give them the points in order to aspire to where they would like to stay. So for us, we're a great feeder to the rest of the organization.
What about at lower price points? Is there a difference there?
For
The importance of frequent guest programs?
absolutely zero. We don't have it. We never will. Our focus is on the owners or the guests themselves. Anybody who comes in with us, you got a construction crew, we will give that owner a rewards program. The cost of our owner is absolutely zero. So you're not paying 5.5 points for every guest that comes in and has a card. Where we do best is the fact that we are a company that does nothing but extended stay. Our salespeople, we have 50-some salespeople dedicated strictly to extended stay, and their mantra is 7+ nights. That's what they focus on. So when we turn the lights on, we're off and running. And our ramp is very aggressive, and it's dedicated to our own people and how we work and how we position ourselves, and we do not charge our owners anything for rewards. Their reward is having an extended stay America property.
Is it, I mean, it's a function of how much the guest is paying, right? I mean, the guest really, the lower the price goes, price becomes the main determinant of why they're choosing the hotel, as long as it's clean and safe.
Choice is a little different maybe because we're so big. We have 7,000 hotels and I think 55 million Choice Privileges members, which is our loyalty program. Wow, those guests stay longer too, right? It depends on what the stay occasion is for each one of them. So we don't like ignore them, but what we don't do is push that down to our franchisees to pay for it. So we still market to them. We market all of our brands, but at WoodSpring we do not use the loyalty program, and we're not planning on doing that either. That's not the direction we're going. I will tell you that I kind of agree with what you said, is as we move up the food chain, I think it becomes more important. So if you get into mid-scale, we are going to have our Choice Privileges points given to those that stay at our Everhomes. The 14 that are under construction right now, they're all asking for it. We have a really good owners council that we put together, and they want it. But we are going to cap the exposure. So after they stay after 30 days, there's no more cost to our franchisees. So the idea is get them in the door, don't lose all that revenue and those people that are out staying. But then we cap the exposure for the franchisee. That's how we do it.
Gary, anything on?
Yep. Notwithstanding the upper scale, because I think the lower length of stay, you have a shorter night guest, is very important for the loyalty side. But having looked at this multiple times, starting back during ESA's heyday when we had 700 hotels, I was CEO of the company, and we did extensive research, spent millions to see if it made sense to do a brand loyalty program, and we nixed it every time. We looked at it at WoodSpring when I was CEO of WoodSpring. We nixed it every time. Prior to launching Stay Petit Suites, that was a big important thing for me because it's a little different than, the pure economy extended stay product. So just like all of you probably done it, but you sit behind the smoky glass screen, and every one of the brands here and others are all represented. And time again, 95% of those focus group meetings that we did, those customers, again, with all these brands that you hear of, said, it's not important. I'd be willing to stay at our product at the time, Stay Petit Suites, because it's comfortable, feels like home, and that was the most important piece. So I think there's value in certain upper scale locations, but in that mid-price and economy, I think it has almost zero value, quite frankly. And you can save the money and put it back in your product.
Okay. I mean, it's really a function of how much the guest is paying from your full responses there. Okay, we got just a couple more things. Just some headwinds and tailwinds for extended stay hotels. I mean, fairly similar, I think, for the overall hotel industry, but we've got declining RevPAR growth rate, but that's from unprecedented highs. Headwind, falling apartment rents, increasing labor costs, but we've heard from the panel some stabilization there. Rising interest rates. Has anyone tuned in to the Fed? Did they raise again today? Has it been done yet? Nobody knows.
Everybody's
2 minutes? Oh, he's on his phone.
2 minutes.
Okay, 2 minutes. Very slow supply growth. Extended stay supply growth in 2022 was the lowest for a decade on an annual basis. And it's likely to stay below long-term trend, I would say, for 2 years, maybe even 3 years. A lot will depend on interest rates, of course. Tailwinds, the infrastructure bill for all extended stay hotels, capital investment construction is a major generator of business. And so when shovels go in the ground, I mean, eventually that infrastructure does have to be repaired and brought up to standard. That's going to create some additional demand. And for want of a better term, the electrification of industry, these big battery plants and the changeover from the car industry to all electric cars is causing massive investment at the moment. Big developments going on in Texas, Florida, Georgia, other places as well. And that's bringing in a lot of new business. It does create extended stay business. So that's a very good tailwind. One more, which I didn't put on there, is the government per diem. I think it's fair to say the federal government is the largest single generator of hotel demand in the country. It's a major generator of extended stay in certain areas. The GSA reviews hotel rates, I believe, every 2 years, and in order to set the government per diem. And you can look on their website, you can see the history of government per diem by MSA, by county, and so forth. Well, when they review those rates over the last 2 years, they have gone up substantially. So I think there is a better than even chance that government per diem could increase in many, many markets, and that will be a boost to ADR.
Right.
Mark, I've lost my notes as to where ESLA is being announced. It's atrium level. I got a final announcement before we go. 704. A704. Okay. So ESLA is a nonprofit organization to educate and inform stakeholders in the extended stay hotel industry. And the announcements of its launch is in Atrium 704. Starting in just a few minutes. Okay.
I think this was the announcement, so.
That was the announcement. Okay. So any quick questions? The actual clock's gone backwards. It went to 0. It's going up now. We're good. Is it 2 o'clock?
We've had 0 questions.
Yeah, 2 o'clock.
Did you guys come in here to sleep or what?
We would, yeah.
You gave all the right answers. Well, thank you very much for coming. Thank you to the panel.
Good morning. Yeah, thank you.